So hello, once again, friends. Steve Taylor here. I really, as always, appreciate for you tuning in and listening and hoping you're getting something out of these podcasts. So as always, this is another episode of the Do It For Yourself podcast, where we really like to bring different professionals, different business owners, or different really just thought leaders, practice experts regarding, doing it for yourself, running your own business. What are some of the challenges? What are some of the opportunities? And really, we're just, bringing these people together to hopefully share ideas and thoughts that hopefully can benefit you, right? Because we're kind of all in this together, kind of figuring it out. So today, I'm really excited about this conversation. This is something that comes up a lot in my practice. And business valuations, right? What's it worth? How do you get to the worth? I'm looking to sell, everything that might be. But David, I have a really an expert, a guest today. David, can you tell us, a little bit about yourself and your business?
Sure. Yeah. Father of three. I've got three kids, 10, 6, 5, girl, boy, boy. Married my college sweetheart from the great university in Georgia Tech. I'm an Atlanta native. And yeah, I started entrepreneurship about 5 years ago. I'm a recovering CPA. I used to be the guy that you would call to do your tax returns for your business or even for your personal. And then I migrated into investment banking, which kind of got me on a path of selling businesses and raising them capital. And then found this great career path in valuation services, which is what led me to this career in business valuation and intellectual property valuation. And we launched Sofer Advisors about 5 years ago. And we've grown to about a 15-person boutique scattered around predominantly the East Coast.
That's wonderful. Wonderful, David. And so, I think I see many times those in the business valuations or this in areas, they do have that accounting background, right? That's one of the first things that you need to understand. How do the financial statements work and all the like. So, your background was preparing, tax returns, and you said you got into investment banking. What really is the aspect of really just focusing on valuations what from your experience, your history, why did you decide to make this kind of like your niche focus and the business that you started out on?
So there's sort of two answers to that. The first answer is, to me, it was the perfect marriage of my two career paths that I had gone down. The first being the public accounting and the second being sort of the investment banking side. I felt like public accounting was really more like driving a car, looking through the rearview mirror, which if you think about it, you can't last very long driving a car, looking through that rearview mirror too long. And so that's what led me to Leap. And then investment banking was very forward looking, very much more analogized to, okay, we're driving the car, looking through the windshield, and occasionally checking the rearview mirror like we should be 90-10. But I was niched, and I missed the client diversification that I had in public accounting. So for me, this career path really married the two. It felt like applying accounting, right? Applied accounting, if you will, because accounting in your numbers are the lifeblood of your organization that tell the story, or at least to start to tell the story, right? And then we're driving the car out the windshield, right? We're forecasting, we're projecting, it's about, are we hitting plans? What are the goals? Are we meeting these initiatives? Are we making changes in the company to hit those initiatives, right? And I got to get away from the nicheness of only valuing one type of business time and time again. And while I do believe there's riches and hitches and all that, I do think you do need to have some specialization, which we call industry clusters. But I get bored if I'm just doing one thing over and over and over. And so for me, getting that client diversification in all kinds of different industries, all different client sizes, all different stages of development. So that's sort of the first answer. The second answer is this, unlike many former duties I was doing for businesses, you have to show me why, if I have two cars side by side, why does your car always outrun the other one, right? Only there is no car, right? This is talking about your company. So for me, to do this right, you have to lift open the hood and you literally have to show me the unique processes, model, systems, people that make this happen, that you get these disproportionate results. And for me, that's one of my favorite things, is getting to see so much diversity in practice. And some of the sleepiest industries you can imagine have highly, highly valuable businesses and assets. And so it's those combination of those two, stories is how I would answer your question.
Yeah, I love that, David. That's kind of why I do what I do now. Rather, when I was practicing law, it was very transactional. I was doing the same thing over and over. And now we get a new client and they show up and they're just all different, right? There's always those nuances and everything to it. So I love that. I love that answer. I couldn't agree more. I love the different challenges. So, I've been having a lot of conversations. The issue has been coming up a lot over even the last couple of years, right? There was this huge influx of capital into the economy. There's a lot of companies out there, a lot of private equity that has cash that they want to deploy and everything. And a lot of people that maybe weren't thinking about selling their business in the past are thinking about it, right? They got a knock on the door, or certain people are, getting older, and they're thinking about what's next, or they have partners they want to buy out and everything. So if someone were to come to you, or really, at whatever stage you get involved, and really like at a kind of high 101 level, like what are the things that they should start thinking about, maybe now, or what are the things you're going to look at to really at the basics to, when you're going to do this valuation, what are you going to look at, and what are going to be a few of the issues that are either going to detract from valuation or add to it?
So there was a lot there.
Yeah.
But so let me start with this, since you brought up the context of M&A and a lot of capital and aging population, and that is all real. And usually the statistic I'll share is the number one exit planning technique, like the number one way you will exit for over 80% of companies, and some industry groups will actually say it's over 90, is attrition. And when I say attrition, I get people to imagine their front door of their business, and there's maybe you've got that LED sign, or you've got a manual sign that says open, and one day it just is off, or you turn the sign the other way. That is most business owners' current exit plans. There is no plan. Mm-hmm. And so the plan is, I'm going to take as many distributions out as I can, reinvest those things into the retirement accounts, public markets, maybe real estate along the way. And maybe someone like you, Steve, who's a CFP, tells them, look, you have enough to meet your goals, so forth. And so one day the business that's it. They don't think anyone will buy their business. They don't take any steps to prepare, right? And so what do you think the results are, right? Not mm-hmm. very good. And so that is, to me, a crime. That is criminal. That so many businesses, these things that have value, whether they realize it or not, just dissipate. And then I feel. Mm-hmm. Go ahead.
Yeah, I'm sorry. Let me stop. I love that. I love that point. And that's really we'll to start there. There's a lot of these people, and I see a lot of them, right? They're just going to die at the vine, or they say die at the desk, or whatever their business is. For some people, though, maybe that's okay, right? Maybe if that was part of their plan, I like to tell them that's part of their plan, right? When they go there. So for those people, because I think there's a lot of my business also, the financial advisory business, or people that think they're so uniquely specialized that they can't ever do it. How do you start up that conversation with someone who doesn't think their business is sellable?
Oh man, yeah, that's a loaded question.
Yeah,
as well. Well, again, we've got to look at it, right? I've had law firms, to leverage your other credential, that I have plenty of attorneys that tell me a law firm is not worth anything. It's always zero, right? Well, then mm-hmm. I always say, well, then why do I have evidence of law firms that have sold? Like, if you're right, why are there ample transactions of law firms that have sold? Like, clearly mm-hmm. something's disconnected there, right? So, we want. I view what most business owners, to me, don't truly have a formal plan. They enjoy what they're doing. They don't really think about selling when they're enjoying what they're doing, right? Mm-hmm. Maybe business is doing great, right? Nobody's stressed when things are really, really good, right? They usually think about wanting to do something different with their life when maybe things are more stressful, right? Or the business isn't doing as good. And that's the exact opposite best time to when you should want to sell, right? So it's this counterintuitive, it almost reminds me of behavioral finance versus traditional finance. And so the story I always share on like what their current plan really looks like is the way I pack when I'm traveling. My wife, mind you, has already been packed for 3 days. It's organized. I mean, it's perfect, right? Everything she needs, it's there. Me, it's 3 a.m. We're leaving for a 6 a.m. flight in 30 minutes. And I've got to scramble, throw everything I can that I think I'll need into a bag. And what do you think happens, right? Do I get to my destination? I get to my destination. I plan to be in Aruba and I show up with things in a bag. Problem was, I probably had to go buy some things that I forgot to pack because I was rushed, right, to get out to the door. I can guarantee you it was not organized, right? There are probably things that could have been done much, much more smoother, more effective, more efficient, right? I still got to my destination I wanted. That was my goal, right? But there's a different way my wife gets there and how I get there. And unfortunately, business owners get there with their exit plans the way I get there, the way I pack. And then just to go back to one of your questions a few minutes ago, which is like, what do we look for, right? And you were asking what can detract, from value. Businesses, we'll hear a lot of business owners, especially if they're smaller, say, "Well, we're simple. Everything's simple," and they say that for a really long time, even when they get pretty big. Businesses are not simple, which is why if you ask ChatGPT to value, it's going to say there's too many factors, and it's going to say, you need to seek professional help. So we look at a variety of factors. But the first three I usually spotlight are the owner themselves or owners, right? The employee base, your vendor base, and your customer base. Like we're going to start there and we're going to find out, are there think of like diversification, like to use your CFP credential, right? Don't put all your eggs in one basket. So we're going to look, is the owner doing too much for the business? Like, what duties are they doing versus what other people are doing? When's the last time an owner took a vacation longer than a week? Mm-hmm. Right. And when they did, what happened in the business? Right. And so we're going to assess many, many factors. What's your margin? How does your margin look versus your peer? Because we can't just look at you in isolation. We have to look at you relative to your neighborhood. Right. And find out, well, is your car overperforming or underperforming? Right. At the racetrack. So things that can detract from value, usual suspects are owner dependency. There's too much value tied to the owner and not the brand, not the company. That's a big one. Too much concentration in their customer base tied to too few eggs. But there are many, many things that can attract and detract from value. And that's what's unique is we have to go do that time and that diligence to find out what are areas that a buyer is going to think is attractive. What are areas that I think a buyer is going to think are detractive. And we're going to have to weigh these to figure out, okay, well, is my multiple of earnings the same as the rule of thumb you hear about, or am I above that, or am I below that, right? It's what do I deserve, which I can guarantee you is not usually whatever rule of thumb you've heard or your buddy sold for or Google told you, right? Everybody is a unique snowflake in a good way. And we've got to figure out, is that uniqueness more net more positive or net more on the negative side?
Yeah, that's great. And let me tie a couple things together here. I like what you're saying about the law firms. Yes, I was a lawyer, right? What was that worth? For me personally, it was just my stable of cases. I sold them to my ex-partner, and that's, he just paid me out on those and whatever they might be. And really those, professional law firms, professional service, financial advisory, any kind of service-based firm, right? It becomes really dependent about the owner. It becomes their name. They might have their name on it. It's interesting. I see your branding, right, is a different name on there, right? And like that's your business, right? You're selling advice and you're going through it in items like that. And so as we talked about, the person who might not think that's sellable, or they might be reluctant, and you say you have information that's different to that. So for someone in this professional services arena, right, where you talk to them and you say, hey, listen, there might be some value there. What are some of the steps that they can start taking to prepare themselves and really, to create some value for their business?
So there are many things you can, the way we're going to value a company, high level is, there's two approaches usually for most companies. All right, you're going to come up with some type of multiple. You're going to hear that word a lot: multiples, earnings multiple, sales multiple. That's a market approach. You're looking to the market to kind of help you, determine, well, what is your thing worth? And then the other way is an income approach, right? Which is instead of a multiplication, when I say market approach, think like price per square foot times square footage, right? Only in a business world, we're talking about sales and sales multiple and earnings multiple. So I'm having to compare me versus other houses in the neighborhood, right? But we want to focus on just us too, right? Because maybe we're different than them, and we usually are. And so an income approach only looks at you, and it's sort of like a crystal ball method. We're going to say, well, what is this company going to look like as we go forward? And it's more a division way of doing valuation, where the numerator is cash flow, or, it's a fancy way to say income, or earnings. And then the denominator, though, is all about risk and rate of return. And so that multiple in the market approach and that denominator, which is that risk or rate of return, those two correlate to each other, where normally the lower risk you have, right, which would increase your fraction value, would generally result in a higher multiple, right? So we got to look at your org chart, find out who is doing what, who reports to who, right? Find out what stressors there are in the business. I mentioned the owner, and you mentioned our brand. We believe every business should, first of all, we believe we should practice what we preach. So that we were very intentional in not naming the business after myself, because of this concept of personal goodwill. Where are they Googling for David, or are they Googling for Sofer? Yeah. Right? There's a very big difference. And we do that. Well, when we work with clients, we get them to provide us, if they have a digital marketing team or if they're just self-managing, we get them to provide us their Google Analytics report out. And if we see that they're Googling Steve and not his brand, that's a sign, that something clearly the way they're marketing is him and not the brand, right? Because when a buyer comes in, right, they're going to want to make their mark eventually. Yes, we're going to need Steve to help transition, help massage relationships. But ultimately, right, if those customers flee, if there's no Steve, we got a problem, we got risk, right? And therefore, I'm not going to want to hand you a pot of money. I'm going to want some of that money to be contingent to motivate you to stick around and make sure these customers stick around, right? So again, it all comes back to a lot of org chart design and duties, as well as customer concentration and customer dynamics. So those are going to be the first two places we're going to start: employee base, owner base, and customer base.
Very interesting. Yeah, the marketing, that's a lot of stuff. I think that I've been working on a lot lately, and looking at other companies. And like you said, it's funny, coming from the law background, what does every lawyer name their firm, right? It's their names. It's a bunch of names all together. It's like if you see a bunch of names all together, you're surprised when it's not a law firm. So, I find that really interesting when you're coming out, you're looking at, the org, you're looking at the people. But to step back on that marketing for a moment, if you come in and, they say somebody, the people are Googling for their name. That's a great question. I'm sure people, oh yeah, I know Steve, he does this. What's the name of his company? And they see it's primarily still dependent on that person. Would a recommendation be, and maybe this isn't part of, maybe this is for, a different business, but on the valuation, like, hey, why don't you work on, marketing and branding your name a little better, and then maybe come back to the table? I mean, is that the kind of advice they give? And then if you give, and if so, typically, like, kind of what's the time frame there? Have you seen, different businesses to get customers to stop Googling this person's name and really, get to that brand? Kind of how long does that take?
So yeah, it varies. It depends. The famous, legal response. What I would say is usually clients will start with some type of assessment. I mean, that's really what the valuation starts out as, is let's just get a bench line. Let's find out what are our attractors, what are our detractors, right? And let's just get a baseline. And we're going to reassess that baseline every year, because we're going to start trying to do things, which is what you're getting at, that hopefully are making a dent in this, right? So best of breed companies will reassess that baseline annually. So they'll do a valuation every year. All right. And then from there, then you start getting into, after you've done that baseline, you start getting to sort of a second phase of the engagement, which is, okay, of all these detractors, which ones should we work on and in what order? Which ones are going to give us the biggest lift in valuation, or what we call the valuation gap? This is like what your company could sold for if it had looked like this, which it doesn't right now. But for me, it's great, because now valuation has gone from sort of a scoreboard metric of just, are we winning? Are we losing? What's the score? How many points do we have? To now it's really a tool, more of a roadmap tool instead of just a scoreboard tool, right? And that's really where I hope that people use this is, yes, it's a great tool to help you get some tactical strategic decisions answered, things like estate planning and adding a partner or, a dispute and so forth. Yes, it will help you make the right decision, give you insight for that, get you something, that's independent and gives you an answer. What's the score? But then back to that strategic planning need, right? But where do we want to get to? How big do we really want to get? What sale amount are we really striving for?
Right.
And so then once we know which factors we're going to work on in which order, if it's a marketing theme like you asked about, then maybe we need to bring in a marketing consultant to help us, because maybe it's not the brand, maybe it's the messaging of the brand, right?
Right.
And so that's when we start to pull in this, almost like a VFO, virtual family office type concept, where you're bringing in best of breed practitioners and consultants and advisors if the client doesn't have the team internally, right? So every business is different, because if they don't, a lot of the clients I work with won't necessarily have a marketing team. And so we might need to pull in people to help us do a further, deeper assessment on that to figure out, okay, within marketing, how should we adjust? Now, in my experience, I always picture a business like the Titanic or something, like a giant cruise ship. And these changes we're talking about are like the little tugboat.
Right.
It takes a minute to turn that ship around, more than a minute. And so it's the same thing with these types of changes. Usually you're going to start to make tactical, decisions with people, and do what I consider are like 90-day sprints. So once a quarter, you're making a change, right? And you do enough of that, you start getting this 1% a day, it's like 1% to the 365th. All of a sudden you look in a year, you've made some big change, right? Which is why in a year you reassess that valuation, right?
Yeah. I think that's great. I think a lot of people, when they're looking to sell, all they're thinking about is top line revenue, right? Top line revenue. This is all that matters, right? Grow revenue. I want to sell for a multiple of revenue, right? But there's so much more to it, as you say. And I'm wondering, within, the arena, say a lot of the people I talk with, clients, they have a business, gross sales anywhere from, 2 million, under 10 million, right? And that kind of area. Some, and I would like to talk a little bit about partners, right? Whether selling to a partner or selling to the outside, but they're really in that area. And let's say there's maybe, one or two partners. Are there any particular things that you see that come up really often when you talk about detractors, to say, like, if I could, what I see most commonly, and the thing that we're kind of working on with these entrepreneurs, these business owners, that comes up time and time again, is there any kind of particular things or one thing that kind of comes to mind that maybe you just see kind of recurring over and over?
I mean, the immediate thing that popped in my head as you described the partner dynamic is usually, I'll imagine like the 50-50 partnership. Okay. Because we see this a lot. And eventually things can sometimes sour a bit.
Mm-hmm.
And a dynamic that seems to surface a lot, which scares me into the 50-50 model, where now I'm kind of like, one of you needs a bit of control. Like someone should be the director, to break the deadlock, right? 50-50 it can be very dangerous. It can still be very effective, just like a marriage, right? Mm-hmm. Some marriages are super healthy and some aren't, some eventually aren't, right? And same thing with a partnership is, we see a dynamic where usually the two partners have different skills and value they bring to the company. Maybe one is more a doer versus a bringer, right? It's almost like minder, finder, grinder kind of concept. And so we often will see one partner who starts to have this, belief that they're more important, or maybe they even show that, like they actually get paid more over they structure it that way, even because they bring in the revenue, that they're tied to the revenue. Whereas the other one is maybe more that worker bee, who they couldn't execute the work without this person. Mm-hmm. And so we see a lot of strife with partners, when it's sort of a 50-50, or there's just no one that kind of has control to break the deadlock. So that's something that surfaces a good bit, which obviously is a little bit more of a negative story, right? But again, some marriages are great and 50-50 works fine.
No, I love that. And I love that that's what came to mind, because that's what you see, right? That's what you see, that's what's happening out there. So when you come to those situations, I mean, I think that was very common in every professional service businesses I've been with partners, like it tends to be the person that brings in the business feels they're more valuable. And then they structure comp that way, right? Yes, I agree. I understand. But then really, like, as you mentioned, without the other person, how do you get that done? So in those situations where you're, you're coming in like that, and I guess they want this valuation because it's a business divorce, let's call it, right? Maybe we'll go down that. It's a business divorce, kind of, partnership, like that. What do you see in those? Because I would assume many times, many of them, they want to continue working on, but they're trying to separate, the kind of contracts like that. Like in those initial business, divorces, what are some of the issues that you see that come up that if two partners, let's say, are starting a new partnership right now, like, hey, if you can put these one or two things in writing, this is really going to just give you a better chance of succeeding, right? Because you'll have addressed what leads to the divorce. And maybe, like you said, it's a compensation thing. But what are a couple things there, words of advice for people that are coming into kind of a new partnership that, hey, address this. You're going to thank me for it.
One is have a team of advisors is one comment. You need to have a really good, solid business attorney to help you, get started on the right foot. And if you've already begun, you've been operating for a long time, this is kind of like, when's the best time to plant a tree? Well, it was 20 years ago,
Right.
When we started this thing, but second best time is right now.
Yeah.
So, everybody always kind of assumes everything's going to go great. Right. But I'm a more plan for the worst, right? Hope for the best. And so having strong legal entity documents that already address where people have already thought about what will happen if something happens, if somebody gets disabled, if somebody passes away, if somebody wants to retire, all of these kinds of, mechanisms that people don't think are on the short term or intermediate term horizon. So that would be one is get your operating documents in order and starting to talk about these things. Once you're in the moment, now we're starting to get into some of that behavioral finance where emotions start coming into play. And we try to get clients in those instances because usually what will happen is, they'll describe the dynamic to an advisor, it could be a financial planner, an accountant, somebody that they trust on what's going on. That individual usually then suggests like, hey, you're going to, if someone's leaving, you're going to need a valuation, right? And that's what gets them towards us, right? But we have to be very careful on how we structure this agreement, because the other side might feel like they found their person, like a hired gun perception. And we have to show that we're completely independent in this. And so I oftentimes will pause immediately and advise that they bring the other partner or partners into this discussion, to have them jointly engaged in the hiring process. And then not only that, once we've been engaged, to have them completely involved on every email, on every diligence call, in order to make sure that their opinions have been heard and so that it's been collaborative. So when they get a result, because we don't know who's our result is going to support, if either, because sometimes we make both of them mad because they're both wrong. So that, even just how you structure, working through these partnership dynamics can be important, where we then become more of a neutral as opposed to working from one side, if that makes sense.
Okay. Yeah, no, absolutely. No, I've had that challenge earlier, this year, with, business owners are coming in and they're getting rid of one of the partners they're divorcing. Then the other three come and say, well, let me be very clear, who I'm giving the advice to and how we're working on this, right? I don't want to seem biased. That's great advice to bring, even to hopefully make a negative situation not as bad, right? To really increase that communication throughout that whole process. So I think, let's, to stay on this kind of partnership, theme, or, the small business theme, items like that. So, to really, you address and you went through, right? Listen, you're getting these things together, get someone to look at your business. You got to take these 90-day increments. You got to work these things out and stuff like that. When someone starts to think and have that idea, hopefully it's not just because things are going bad, but when they're trying to think, hey, you know what, I want to sell. I think I want to sell, until potentially they actually go through and sell. I mean, what do you think is a reasonable time frame to tell these entrepreneurs that when you start thinking about it, you start working on it? What's a reasonable expectation before you actually get to where you're going to sell it and hopefully maximize your value?
So just continuing on with the traditional finance, behavioral finance, but traditional finance would generally suggest an answer longer. 5 to 10 years would be ideal. because again, like making changes in your business takes time to either bear itself out through the financials where you see the sales impact or you see the margin impact, right? It just takes time, right? And so we need a buyer to believe that what we've done will lead to consistent, repeatable results there, right? So you see direct impact, or there's indirect impact where the changes we made have, again, going back to that fraction, right? It's a fraction, we can make changes to a business that we can directly see that impact the numerator, right? Which is the cash flow, either the revenue or the margin, the cost, whatever, right? But then there's other changes you make that you don't see through the financials. So this is getting to risk. And everybody likes to focus on the former and forgets about the latter, right? And so, because they like you said, sometimes they want to look at that sticker revenue number or sticker earnings number necessarily, right? And, that they're bigger and so forth, but they forget about the risks. And so doing something as simple as hiring a BD when you've never had a BD to pull some of the sales duties off the owner and reduce some of that dependence can lower risk. And if we lower the discount rate in the denominator, and I might even get more revenue, now I could have a multiplicative increase in value where I impacted the top and the bottom, right? And so again, like 5 to 10 years would be the traditional finance answer, where when you're within that window of even potential, it's a great time to start thinking about these kinds of tools, right? However, then there's behavioral finance where, well, unfortunately, not everybody does it that way, right? And so, but if the answer isn't, with a year involved, where you've got 1 to 3 years, can you sell? Can you make a few changes? Yes. Again, it's like a house. If I don't have enough time to renovate the house, right, then I'm only going to be able to make so much change. Could I stage the house? Could I throw up some paint? Sure. Am I going to be able to do a massive renovation of all the floors and the kitchen and the bath? That's going to take time, right? Or put an addition on the home, right? And those things could add value, significant value, like an HGTV show, right? But if I don't have the time, right, I can't do those things, right? And so again, the longer the time you have, the more options you have to make change and potentially impact 3 things, right? Because doing these things doesn't just necessarily change valuation. It might not change valuation. It might change terms, where maybe you get more of your money up front rather than deferred or contingent, right? And maybe you get better financing because of these things, right? I mean, to get to a deal, you got to have the right valuation, the right terms, and the right financing to get to a deal.
Yeah. No, it's really interesting. In my industry, it's been really hot that financial advisory firms have been getting gobbled up, right and left, and all these big firms come in. They're really trying to come after you. And it was interesting. I've gone through a couple of discussions with them to see how they look at us, how they value it, the numbers, the qualitative, the quantitative, numbers on it. So anybody out there, if you're thinking about doing it, kind of like an initial little effort with somebody with maybe not being, I don't know, not too serious about it, but to go through that, it's always an interesting practice to go through. But David, I always like to ask, and I'm always very cognizant of, the advice I'm giving, what I've learned, right? Do I follow my own advice, right? Do I ever say something that to people to do that I wouldn't do myself? I'm curious, because you say Sofer Advisors have been around about 5 years now. And this is what your business is, right? Maximizing value, understanding items like that. Is, your personal experience in going through this, what would you say in the early stages of starting your own business? What have you either focused on? What's been the, pleasant surprise or maybe the biggest challenge to think about? Because I'm certain, right? Or maybe you're not, but you're thinking that one day, right, you would want to sell your business. How has that been for you? Like one of the items that has come up in the first 5 years?
I think when it comes to the biggest challenge, and just sharing a little bit about my story, especially early entrepreneurs will have what I call like an expense mindset, right? And they need to shift to more of an investment mindset. So what I mean by that is, I was on the phone once with a friend of mine who started a firm. She was more, in the solopreneur category. And this person spent all day on fixing a computer. Now, mind you, she's not in the computer business, right? She's in like the analysis, number crunching business. Okay. So if we think about our, hourly rate, even, on what we can bill and our core competency, we're stepping over dollars to save nickels, right? And that's expense mindset, right? Is, can I fix this? Yes, but I'm refusing to delegate, right? I should be focused on higher value, activities. And so for me early on, I had a lot of that expense mindset of, well, if I hire this person and they don't bear fruit, that's money out of my pocket of X dollars, right? People forget all of these decisions, they're investment decisions. There's a return on the investment, right? And so, and that's tough, the shift from the expense mindset to this investment mindset. And then and it sort of relates to a second part answer to that, which is just about delegation.
Right.
Too few owners and managers master delegation, which gets back to that concept of what are the strategic highest value activities that I should be doing every day? What are those eat the frog 3 things that I should be doing during the day that will add the biggest lift for me that day? And they don't do it because they get distracted by the noise of lower, easier tactical things, think, well, someone else can't do it as good as me or as fast, all of these little things. And so too few owners, for a long time, will shift from this expense mindset to an investment mindset, or really master this letting go and delegation. So that would sort of be what I would share there. And then just to comment on something earlier you said about what you were seeing in the financial planning sphere and the investment advisor sphere of consolidation. That story is ubiquitous. Mm-hmm. There is literally not a single industry, that this is occurring in. Janitorial supplies, HVAC, plumbing, accounting firms of all things, which when I first started my career, was like, that's a never. Private equity will never come into this. It's here now. They're about to figure out how to do law firms. I mean, we're getting close. Okay. So it's coming, and it's probably already there. And I would imagine anyone listening to this interview has probably gotten the marketing email campaigns from somebody. Mm-hmm. You can tell when it's some, marketing campaign trying to say, are you interested? Are you tired? Are you burnt out? Would you want to, do you need people to practice with, so forth? And the statistics are crazy. I mean, when this whole consolidation boom began, it was really at the enterprise level, firms above 1,000 employees, and it's been like that for multi-decades, where those firms are getting smaller and smaller. Well, then it went to the 500 to 999 category, right? Which is still pretty darn big size firms. Yeah. And then they've had massive decade over decade declines where there's just not as many businesses there. So what does the smart money do? Either private equity or corporates who want to consolidate, they go smaller. And then they went into the mid-market, where maybe you're in the 100 to 500 employee count range. And you're seeing multi-decade over decade where the numbers of businesses that are in that size are getting smaller and smaller. And so in other words, the money keeps growing, and you have to redeploy it to earn your return. And now they've gotten to the low middle market. Now we're talking about 20 to 100 person firms. And we're seeing, for the first time ever, multi-decade declines in overall numbers of businesses, regardless of industry, right? Yeah. So the only left, over the next decade are going to be the smallest of businesses that are 1 to 20 employees. Yeah. In fact, if you look at the numbers, out of 12 to 12.5 million businesses in the United States, almost 11.5 million of them are in that smallest category, right? I mean, that's why they say, the small businesses who create the jobs in the country, which is true. And that's the only segment where the number of businesses is growing decade over decade, from 2000 to 2010, from 2010 to 2020, from 2000 to 2020. And if you want to be a firm that has the potential to sell, because they're going to come downstream, only the firms that are most prepared and that look the best will actually be able to sell. Now, the question is, will they be able to sell? That's one question. And then will they be able to sell for top dollar? It's a whole separate question.
That's a great point, David. I love that. And how you pointed that out, that's really everywhere. And what these big firms in my industry, and I'm sure the other ones, say is that, hey, you're the small guy. You can't survive without our scale. We're going to eat you up, right? We're going to do it differently. So then, to that point, many of us small business owners are like, well, maybe I can make this multi-generational, right? Grow to 10, 15 employees, 20 employees, kind of go down that route versus just sell out, right? And I'm not going to say sell out. I don't want to use that as a negative connotation, but to sell, get consolidated into a larger entity. Do you see that trend just continuing, that almost there's going to be no one out there, or potentially might there be a reversal of it, that eventually they're going to start gobbling them up? It's going to be too top heavy, and it's going to spur people at those entities, when their contracts, when their non-competes, run out, to go out and do it again. Do you see any end in sight for that kind of trend?
So I think inorganic growth is here to stay in some form. So that's comment one, is acquisitions are going to be, they're here to stay. It's a great way to pick up talent, when debt is at historic lows, even today, in a historical context, it's a great way to grow. But when I ask myself, well, why is that 1 to 20 category growing? And I don't just mean growing like 5-10% a year. They're growing at 20-30%, pretty high growth rates. There will always be this dynamic where, the bigger the firm gets, the more sluggish they seem to get. They just are not as agile, which is what leads them to acquire. They acquire the most agile, most innovating, for whatever reason, their culture, because they start leaving from certain things that made them unique, and they start creating a process. And sometimes that process can stifle the innovation that's needed, because they don't take this view of, we must reinvigorate our firm year after year. We have to pretend like we're going to be disrupted. And so they get large, they get lethargic. And then what happens? People leave and go, you know what, there's a better way. I think we could do it this way. And maybe that doesn't fit the culture of the firm anymore. Maybe once upon a time. And what happens? Entrepreneur starts their thing. So I think there will always be this dynamic of, yes, consolidation, but then you'll also have this dynamic of sort of adjacencies in the market that will create opportunities for people to start businesses and outrun the competition, even if they're much, much larger. You bring up, again, I think of technology. Technology is a great way that democratizes regardless of size, and seeing what we've got coming with AI, that's efficiencies that we're going to be able to achieve, at all levels. And then my final comment, since you brought up sort of the multi-generational, and again, I hate, being negative, on some of these things, but only 30% of businesses make it to the second generation, right? Only 10% make it from Gen 2 to Gen 3. So when you cross multiply the number of businesses that actually go 2 generations down, you only have a 3% chance of that occurring. And most of the reason for this is a lack of planning. They're running out the door, trying to pack, and they're not doing the proper planning, because it takes time. And the changes you need take time. These aren't months and weeks type changes.
Yeah, I love that. I love that. Well, to end up on that, David, really bringing it all back, is the idea of planning, right? You have to think ahead. You have to think, through this. And if your plan is to grow and sell it to a larger entity, so be it. But if you want to keep it, right, and maybe bring in your kids or whatever it is, that just speaks more so to the fact that you got to get on this quicker, and sooner, and really put these, items in place, because, not to be negative, but the numbers are just against you. It's not really what's been happening. So David, I really, really have appreciated this conversation. I think it's been tremendous. If you can, maybe finish us off, give us a little information about Sofer, how to learn more about you.
Sure. Yeah. Thank you for having me, Steve. Yeah, it was my pleasure to be here today. You can find us on every social thing out there other than TikTok. Our company's at www.soferadvisors.com. My email is david@soferadvisors.com. I'm on LinkedIn, Facebook, LinkedIn, we're on all the things. And again, thank you for having me here today, and look forward to seeing you again soon.
Thanks so much, David.